Good morning to everyone over here in Asia. Very, very exciting morning to you all. We've got a interesting article that we wanted to discuss today. An article related to venture capital and private equity. It's really actually quite amazing. So first and foremost, my name is TW. I am senior partner here at Capital Group. Just making sure everything is live and ready to go on YouTube. Was going to do it on LinkedIn as well, but I ran into some issues at the last minute, so it is what it is. Capital Group. Just making sure everything is live and ready to go. So let's get started with the following. Article at hand. Yeah, so the article at hand is dealing with, it was really actually quite, I look, about a week ago on Zero Hedge, I was going through the article, and it really made an impression with me. And then I reached out to Mark Jeftovich over at bombthrower.com because it was originally from bombthrower.com, and then reposted on Zero Hedge, where got more reach. And it's really just an outstanding article. And I reached out to Mark on LinkedIn, actually. I think he's in Toronto, and I wanted to see if he could join today's webinar. It's just because it's just, well, today's live stream, I guess, because it's just such an extremely well written article, which clearly details what's going on with venture capital, private equity, and specifically valuations. So this is an example of essentially an M&A, a merger and acquisition. So let me just go ahead and start to read the article, and then we can dissect it a little bit afterwards. So here we go. So this was posted on the 21st of May, so almost a week ago, and that means it says, this past weekend, I was at the Canadian Bitcoin Conference in Montreal, where I moderated a panel on Bitcoin as a treasury asset for corporations. At the time, I disclosed that 100% of EZDNS retained earnings are in Bitcoin. So pause right there. Yeah, Mark Jeftovich, according to LinkedIn, is the, I guess, founder and owner of EZDNS. So that's for context. All right, back to the article. And that the market value of that Bitcoin is currently 300% of the retained earnings balance from our latest year-end financials. Parentheses, hold that thought. The main takeaway being, I have this business going on over 25 years now, and there's a stack of sats, cash, or any liquid asset that the business has built up and continues to grow and retain earnings. End parentheses. End of the first paragraph. Okay, moving on now. Also in Montreal, there resides a private equity firm that has been bugging me to sell them the business for a long time, years. Since the relationship has been cordial, I decided to take an in-person meeting while I was there, and the main guy came out to Le Mont Stéphane, where I was staying, and we had lunch. What became clear as we talked was that he had no interest in how EZDNS is actually positioned or differentiated, let alone what our growth trajectory or levers were. Whoops, let me just click here. Okay. So, moving on. Yeah. Next paragraph. All he really wanted to know was the top line and EBITDA, earnings before interest, tax, depreciation, amortization. We don't grow our companies organically, he told me. We just acquire them, as many as we can. The plan, it turns out, is to hoover up as many small businesses in the ISP, MSP, software as a service space as possible, and in a few years they're going to mash them all together and take it public. That's the plan. It wasn't even really a roll-up from the sounds of it. There was no platform business into which the rest would be shoehorned. It was just going to be a mudball. He asked point blank if I would be interested in being acquired, and I told him, like I always tell him, if the multiple is high enough and terms don't suck, sure, otherwise no. That's when he explained his problems to me. When interest rates were zero, we could pay 5x or 7x EBITDA for businesses like yours. But now with interest rates higher, we can only offer 3x or 4x EBITDA. In my business, believe it or not, private companies typically get acquired for a multiple of revenues or else a private equity north of double digits. Price to earnings, PE, north of double digits. I was also having a hard time understanding why his cost of capital had somehow become my problem. After explaining how the valuations work, I pointed out that of the publicly traded businesses in our space, one was traded at a price to earnings of 13, and the other two were losing money. Oh, but public companies are a completely different animal, he lectured. So, in other words, I asked him, just to confirm I understood this correctly, you want me to sell you my profitable and growing business for less than a fraction of cash and at a shitty low multiple? Exactly right. He didn't actually say that, but he confirmed it, but with the qualifier, we let you keep the cash. I pointed out to him that if I just keep the business, the cash is mine anyway. It really was unfathomable why anybody would take this kind of deal, but I did clue into what the entire value proposition of the private equity fund was. Bullet point number 1, borrow money and use it to acquire private businesses at 3x to 4x EBITDA. Bullet point number 2, flip the agglomerated holding company public at 10x to 15x EBITDA. That's it. No overarching blue ocean strategy, no thought toward compounding, no organic growth, no differentiation. It was just an arbitrage play, using borrowed, made-up money to sweep a bunch of privately held small businesses into a public entity and capture the spread. This was not an isolated incident. While EasyDNS has had acquisition overtures from the very beginning, the tempo definitely increased during Corona and has remained elevated. And we're a pretty small company, tiny compared to where you would think private equity typically plays. While I was usually demurring before we got to talking about multiples, the overture had been cutting to the chase earlier in the communications process, and it's coming in around 3x to 5x EBITDA to buy a business with SDE around healthy double-digit percentage on top line and with more cash on the balance sheet than the total acquisition price. It's insane, but given that we're in the shadow of a craze where even SPACs were being valued in the billions before they even had a business focus, it's unsurprising. To be clear, I'm not planning on selling the biz. My flight back from Montreal was delayed, so I was willing away the time shitposting about private equity on Twitter, and some clients were expressing concern that I was lucky to exit. I am not. As a Bitcoiner, I have extreme low time preference. I wrote about this in the inaugural Bomb Thrower post and recently revisited in a Twitter thread. Okay. No exit investing. Totally alien concept to private equity, venture capital, and fiat finance. As the fiat money system's debasement has accelerated, I viscerally understood that the business is the asset, not the currency these swindlers are trying to get you to trade it for. I wrote about this years ago, even before M2 blew out about 30 trillion over the pandemic. Yeah. And I talked about the business as a no exit investment. Okay. It is hard to build a successful company. By this, I mean a company that is self-sustaining, maybe an off year here and there, but for the most part healthy and profitable. It's also hard to build a brand. So the prospect of selling off a successful company and an established brand for a pile of money, the big question I never answer is, and then what? Thanks to worldwide government interventionism and central bank incompetence, all asset classes are malignantly distorted beyond recognition. What the hell is one supposed to do with the proverbial briefcase full of cash? You'll hand 25 to 40% of it over to the government, even more come June 25th here in Canada, and what's left then carries a near negative yield because that same government has a targeted inflation policy. Start all over again? With your negative yielding cash and a non-compete barring you from the one biz that you know best and your customer base and brand gone, the only asset I can possibly think of that produces the kind of return on equity that EasyDNS has for me is EasyDNS itself. So why sell it? The private equity playbook is having a hard time being run at these higher interest rates, so hold company builders and funds are out scouring the terrain for healthy, profitable, small, privately held businesses to buy at lower valuations so they can mash them together and flip them onto lumpen investors at higher multiples. It's easy to understand why once you realize that because fiat money is disintegrated, in order to keep expanding a financial system built on debt, you have to financialize all the things. End of article. So yeah, with that being said, author who could not join us today, but we did reach out, Mark Jeftovich of EasyDNS in Toronto. Yeah, the article is just spot on. Everybody that we've been, yeah, we don't really focus on M&A, but certainly listening to something like this is, this article is, when I read it the first time, you just sort of jump into it and you say, wow, this is relevant, this is timely, and this is proof positive for all of us who are business owners and for people that do try to poke and prod around and sort of get engaged in either private equity or funds, and then the M&A part, which is really the other side of the table. Our investment thesis and a big part of our company is of course Bitcoin, as and it's been that way really since 2017 when we had the idea to start the company, was to leverage its upside, and build around or make it a large percent of our activities, simply because it's not US dollars, simply because it's not Hong Kong dollars. And we know, unfortunately, after well, during and after the Corona pandemic, it wasn't just the United States government that began to print money like crazy. There's a lot of other governments that are giving handouts, and what we've told many folks in private is that we do. There's been many cycles, but there was a crazy 2020 and 2021 sort of lockdown frenzy, and that extends to the real estate boom in Singapore. That extends to the equities boom that we saw in 2020. So if you were to look at the market crash of March of 2020, and then look at where the stock market was even before the end of 2020, all the losses had been clawed back and then some. And then 2021 for us was certainly the year of NFTs and crypto, so the crypto was sort of delayed by 6 months. But this article just comes back to simple acquisitions, mergers and acquisitions, and it is because the guys that work in private equity need to manage funds. They need to give a return on investment, and then they're also dealing with loans and debt. It's basically as fast as the money comes in from the banks, which they're cozy with, is as fast as they will gobble up those clients at ideally as low a as cheap and as discounted as possible, as opposed to giving the owner of that business who's willing to sell a true value add, a true sort of maximizing of value or maximizing their exit. So with that being said, this is our opinion for this article. It's really spot on. Unfortunately, could not get the wonderful author himself, Mark Jeftovich. It is late over there in Toronto, but either way, very pleased to read the article, and every single word of it is proof positive of some of the what we call vultures in the industry, but it also speaks to just fiat versus Bitcoin on a spectrum or on polar extremes, because there is gold, there is silver, there is real estate, there's other asset classes, but if entities that call themselves private equity or venture capital or M&A gurus step in and they only have to toss money at you. Ideally, if you are thinking of selling your business, you probably do not want to just take cash. You would probably want to get some sort of dividend or stock options or ownership in the company that's acquiring you, so you are able to hedge your bets or spread your bets. Because the last thing you want to do is just be you don't want to be sold short in a way. Because all of that cash, as you said, bag full of cash, it's immediately depreciating, as opposed to continuing to build value inside the company, number one, or with an asset class like Bitcoin or others that are not at negative 3-4% per annum when it's according to inflation. Okay, so with that being said, covered that for now. Thanks for watching, and check you guys again soon with another interesting article and update.